Thank you very much, Lucille. Karusha, perfect. I think there are one or two people that still need to arrive, but out of respect for those that are on time, let's get the ball rolling. Thank you very much for joining us once again. Marius is in Cape Town. He's going to be chatting to us about due diligence. Now, I just want to put things into context. You know, we've spoken about due diligence, and due diligence can be construed and understood in many contexts. The context in which we're going to look at due diligence and get an understanding of it and its relevance in our world is about investment due diligence and fund manager due diligence. And Marius is an expert in this area. Just a little trip down Evolution Road. So back in 2014, Wessel Oosthuizen and myself were invited to sit on the risk profiling work group. And after a couple of months, we put out a white paper. But during the course of my interaction with all these learned folk, academics, experienced people, the realization dawned on me, and it was a bit of an aha moment. Without really realizing it, over the years, we in our little practice had developed our own risk profiling processes. The one tool that we were missing was the risk tolerance, and we found the Phenometrica one. But as far as needs and objectives and capacity was concerned, we pretty much had those bases covered. So when we put out the white paper to the industry, and it was pretty much adopted by the phase ombud as being the de facto definition of risk profile, the realization dawned, but hang on a sec, you know, what's next? It's a little bit like being all dressed up with nowhere to go. So you've determined a risk profile, and you've done it diligently, and you've done it well and credibly and beyond any reproach. But what's the next step? So the next step is how to actually take that risk profile and then build a portfolio that will match the risk profile. Not only build the portfolio, but manage the portfolio. So this is where Marius comes in. I was very fortunate at that point in time. We had a couple of years experience of building and managing model portfolios, both with Glacier and Sanlam Multi-Manager, and more latterly at that time with 2IP. So we had certain insights into the processes behind building and managing portfolios, the due diligence processes from an investment and from a manager point of view. So without stealing any of Marius's thunder, I'm going to hand over to him. He's going to take over. I'm going to sit back. If you'd like to type in any questions, I will do my best to respond to them in text. And if we think it's relative to everyone, then we'll respond as well. So, Marius, if your microphone's on, would you care to take over?
Am I live? Okay, I accept that I'm live. Thank you. Good afternoon to everybody. I think the purpose of this session that this afternoon, and what I would like to try and achieve, is to try and go into a lot of intense detail on the due diligence process itself. It is such a multi-layered process, and sort of the level of work that needs to be done. It's a diamond with so many cutting edges that we won't be able to cover all of that. But my heart desire is that we can sort of have an understanding of the broader context. Like anything in life, if you need to, if you want to have, if you need to make a decision, it is always, you start with a starting point is what am I trying to solve? And why I ask this question is, in the past we would get requests from IFAs asking us, please compile a list of questions that we need to ask from a due diligence process to make sure that we cover ourselves. And then only to sort of get to the sort of understanding saying is, but having a list of questions would not be sufficient. What is your starting point? What is it that we are trying to achieve? And I think there's, for us as investment advisors and investment managers, I think ultimately what we want to achieve is better outcomes for our clients. And I think it's very important for us to understand that if we want to have better outcome for our clients, we must make sure that we put ourselves in a position that we can make better quality decisions. So better outcomes is always a result of making better decisions. But for you to be able to make better decisions, what is required is to have better awareness, because it is that awareness that actually informs the decision that results in an outcome. I think there's sort of the context for that's also different if you look at it from an advisor perspective. It focuses a lot actually on out of portfolio sort of discussions and decisions that needs to be made. Is sort of having meaningful conversation with your clients and articulating their priorities and their needs into realistic goals. And the one thing that we've seen time and again is probably for 90% of clients out there, financial planning is about making trade-offs. It is having a solution that would be able to be met that would be realistic based on what they have, what their desires are. I think that is, from our perspective, where we see that the most important part of what needs to be done is from an advice perspective, is having those meaningful conversations, because ultimately that will result into a target return portfolio. This portfolio needs to meet a specific objective. And that is actually go to the heart of the due diligence process, is understanding that based on what this portfolio needs to achieve, what are all the risks that are involved? And if I look at if we just make an observation of what we see happening in the industry, is that there's definitely, and it's also being driven by the regulatory environment, where there's a big shift happening that's moving from sort of selling product and performance to sort of advice. And if you look at the selling and performance, that focus sort of on what we do as opposed to why we are doing it. Now, I've seen Simon Sinek's Golden Circle being used in so many presentations in our industry lately, but I truly believe it is a very powerful concept. If you look at what we've been doing in the past, is we've been focusing on sort of the what as opposed to the why, and the what is a product construct, as opposed to understanding why we do what we do, why are we doing it for the client, why do the client have certain values and objectives, and why it's important is Simon Sinek, he basically in essence suggests that people connect in a stronger and a different way with what you do for them if they understand the why. And I think that's ultimately what one of our biggest concerns in the industry is, keeping clients invested, keeping them committed to their long-term plans. But if we have done our work properly in understanding what is the purpose of what we're doing, what drives our decision-making process, it will help ourselves as investment managers that we connect stronger with the portfolios that we structure, and irrespective of market cycles and the pressures that will come to bear, that we would basically stick it out. And I think that is basically where the advice world is moving, is away from performance selling to far more onto the sort of goal-based environment. Now, part of the question for me is, so why is this relevant from the investment portfolio construction and due diligence process? Is that, well, we know that selling past performance have been destructive. It is something that is easy to sell, but it is not something that clients can. Past performance is not something that clients can consume in the future, and it's usually been done to their detriment. But if you're going into a goal-based environment, then articulating a client's goal at the outset based on their needs and their objectives is one thing. But now you need to have a portfolio that you match to that goal. But in terms of the full process of advice and keeping the client invested, you must also be able to actually do goal-based feedback. So in the past, we would be focusing on giving client feedback on where's the economy and how did their portfolio or funds that you selected for them perform relative to an index or a peer group. Whereas opposed to where the world is moving to now is actually trying to help the client understand, are you still on track? We've articulated your needs. We've structured a portfolio that is purpose-built to meet that, not to exceed, but to meet that need at a future date in time. But if you don't understand the portfolio structuring, how you put the portfolio together, why you've done it, and what your expectations of that portfolio is, it's going to be very, very difficult to actually do annual feedback to a client based on goal achievement. And just by way of an example, so if you have a medium or a high equity sort of multi-asset class fund that is appropriate to meet the client's objectives over the longer term, and the fund is down, or the markets are down 20% in any given year, and the fund is down 10%, on what basis will you give the feedback? Because if you are using sort of some of the traditional deterministic software that will just show you an outcome, suddenly a year down the line, it would suggest that you are 10% behind your goal. But if you understand portfolio, how you structure a portfolio and how the portfolio delivers on the promise in time, you would understand that it is very natural for the portfolio to actually be down. And that the client is not necessarily behind achieving their goal in the long term just because the portfolio has fallen behind what the expectations were. And I think part of the problem we have with goal-based advice at this stage is when you sit with a client and you share with a client that their portfolio should provide, they would require a CPI plus 3, 4, or 5% portfolio. Clients, what they hear is this portfolio is going to deliver this for me regularly. But if you understand a portfolio and construction, you realize that there's a path dependency on how you reach that performance over the longer term. It is hardly ever going to provide on an annual basis the CPI number plus number that you are targeting. It will do it in the fullness of time, but not on an annual basis. And it's important that you understand when you do your portfolio structuring, that you have an understanding of what is the risk inherent in the portfolio, what can I expect of the portfolio, and what do I share with my clients in terms of managing their expectations, that when the markets are down, and they will be down, which is very, very normal, that they would understand that they need to be committed to the process that we are following, because that's what the due diligence is. That our part is the process. Purpose is the why. The how is that disciplined process that you need to follow, that you need to repeat, that translates into a product that will meet the objective over time. I think if we look at as an industry, it's definitely moving from the promise to the process, and that's something that we clearly see. We've been called out on the promise, and this whole idea of selling only clients being only invested in the best performing funds and adding alpha. And it's very interesting. About 10 years ago, there was a gentleman called Jim Collins that wrote a book called Good to Great, where he compared companies and their performance over the long term and trying to sort of identify, but what are the characteristics of great companies? On the first page of that book, it starts with a caption saying, "Good is the enemy of great." Now, one of the guys that I really enjoy his writing is Carl Richards. And he turned it around. He said, well, in the investment world, we've got another problem. We've been trying to sell great and best forever, but clients are never getting it. It's actually causing a lot of harm. In our world, great is the enemy of good. So what you actually need is to move away from this whole best performing and the greatest to having a solid process. And this solid process is actually a multi-layered process. To get to that portfolio that's appropriate for the client, there are various things that needs to be considered carefully and mindfully, and then brought together into what would ultimately translate into the client's portfolio. Um, if we focus purely on the manager due diligence process itself, we obviously also ask ourselves, what is motivation for doing the research? I think ultimately for ourselves, it's actually to understand what is the objective, and based on that objective, what is the risks that we need to take. And a lot of times people would focus on trying to avoid risk. It's not about avoiding risk, it's about managing risk. Um, if you have a client that has a need in the long term, and you reduce the risk in the portfolio that provides him with a sleep well portfolio, it will sort of ultimately end up in him not having an eat well portfolio 10 years down the line because you have a shortfall risk. So it's about truly understanding what are the various risks. And then I think that is at the heart of the due diligence process. If I want a return that is greater than your risk-free rate of return, that is cash, it presupposes that I need to take some level of additional risk. Okay, so how much additional risk do I need to take to get to meet my objective? Ultimately, money management, in my mind, is about managing various risks. And part of the due diligence process, due diligence in its most simplest form is actually an audit process. It's trying to sift through the detail and to understand what are the various risks, what are the risks that I intend to take because I'm going to benefit from it, and what are the risks that I don't need to take or don't want to take. And that is the end result of a due diligence process, is actually having gone through the process of identifying, understanding risk, and mitigating risk to the extent that it aligns with whatever the portfolio's objectives are. I think this is basically the next slide. Is first question is to ensure that you understand all the risks that are involved that could affect your final outcomes. You only want to take the risks that you want to benefit from. You want to avoid the risks that you're not going to get rewarded for. And we'll touch on this a little bit later. So a lot of the effort that goes into due diligence, and when we listen to the discussions in general in the market out there, it's about sort of very return focused. But if you consider things like administration risk, there are certain risks that are inherent in part of the process. But if you get it wrong, there's absolutely no upside for you, there's only downside. And part of the audit process is you want to be in a position that you're not blindsided, that you understand what the risks are, because then you can make a decision on what is appropriate and what is not appropriate. What is the risk that you want to take? What are the risks that you don't want to take? Now, if you look at the industry, sorry, Peter, this is not pulling through. Oh, just give me a moment. This graphic is not pulling through on the. Okay, so apologies on the slide presentation that's been loaded. There's some graphics missing that I think is quite important. But essentially, what it boils down to is you always start off with your investment objective. That's always the starting point. When you do due diligence, and from an investment manager perspective, that aligns to your advice process. So what is the investment objective of the fund itself? Then the first sort of important decision that you need to make is your strategic asset allocation. And your strategic asset allocation is the long-term allocation. It's not based on your views of the world in the next 3 to 4 to 5 years. Strategic asset allocation is what are your best views on all the various asset classes over the next 30 years and longer. And strategic asset allocation would entail, based on whatever the investment objective is, what is the optimal combination of assets, and in what relationship do you need to have them together over the long term to give you the highest probability of meeting the objective. We'll touch on it a little bit later, but strategic asset allocation in our mind is not something that you would revisit regularly. It would only be if there are inherent structural changes that changes the landscape in the long term that you would rerun your long-term strategic asset allocation. On the flip side of that is your tactical asset allocation. Now, tactical asset allocation is not, don't confuse that with market timing. It's not trading the portfolio. Tactical asset allocation is where you look at your long-term strategic asset allocation, you look at the market itself, the cycles and the valuations. And based on that, at the margin, you actually move your exposures around based on what you believe, what are the risk factors in the market, where do you believe is the least risk, what is best price. So there are times where certain markets are, so for example, your emerging markets 3 years ago were trading at a massive discount relative to your developed markets. At that point in time, if you purely went on a valuation basis, it was the right thing to actually move your weighting from developed market exposure to your emerging market exposure. That is a tactical view that you take. It's not changing anything in terms of your long-term strategic asset allocation. The manager selection, it's a pity that I don't have the graphics here, so I'm just going to talk you through it in the absence of having that picture there. So on this side, you have your objectives and you have your strategic asset allocation. This is basically done initially and it doesn't change. Unless your client's objective and the plan change, nothing changes on this side. On the dynamic side of this picture, it's you have to have a tactical asset allocation view, and that's where you also do your manager research and selection. And we will go into that into a little bit more depth in subsequent slides. This is also where you then put your tactical allocation, your manager selection into a portfolio, and then on an ongoing basis, you need to do a rebalancing of the portfolio. We'll touch on that also now, but we don't believe on a mechanical rebalancing of the portfolio. It's something that we believe you should be doing, being mindful of your tactical views of the world and the risks that are inherent in what's happening in the market out there. I think at a very, very core, you get a focus that's either qualitative or quantitative. And there's a difference between the two. A lot of people, unfortunately, out there would have as a point of departure a quantitative process where they sort of look at the numbers, where we believe that your starting point should actually be having a qualitative assessment. A qualitative assessment is basically subjective. This is where you spend time with a manager, with a team, you interrogate them, and you build a view of what you think and your understanding of what their style is, what is their performance signature that you can expect through different market cycles. How consistent are they? What is the consistency and the repeatability of their process? Again, this would be within the context of understanding that the market goes through various cycles. There's not a manager that outperforms in every market condition and every cycle. So it's important to understand who is the manager, how do they manage money, what can we expect from them, because that understanding will inform us how we can use them in a portfolio of assets. And also, what would that individual manager contribute at a portfolio level? If you add a manager to a portfolio, it's either because you believe it would enhance the return or it would be to reduce the risk of the portfolio. But here, manager diversification is actually is key. If we look at qualitative versus quantitative, the qualitative is you look at the philosophy, how do they think, how do they operate, what are their processes, what are the people behind the business. Qualitative is actually more the objective measures and it's statistical risk data. And that's where you look at past performance, and you try and dissect the risk of the portfolio from so many angles that as possible. From our perspective, we always believe that you should start from a qualitative perspective, build up an understanding of the manager, try and understand where they can fit into a portfolio, what contribution they can make to a portfolio, understand, build a understanding of how they, within the different market cycles, would actually give you a performance, and then ultimately then you use the quants to back out whether your understanding of what you thought you've built a picture of does it stack up in terms of the historic performance. The one thing that we passionately believe you should be very wary of is actually on the quant side. If you look at any investment proposal, any fund fact sheet, any communication in the industry, it's always saying, buyer beware, past performance is not indicative of any future sort of expectation. And the problem with what I have seen in the industry with quants is it actually just sort of feeds this natural performance chasing behavior that's been designed into our processes itself. It's very difficult for people to include managers into a portfolio whose track record over the last 3 years have been quite poor. The fact that it's based on the market cycle and the fact that the market cycle didn't favor the investment style is not considered. And what we typically see quite a bit is when people actually backfit portfolios based on quants. And you end up then with a selection of managers that have all done quite well in the last couple of years, and then you dilute manager diversification benefits. There's a reason why they've all done quite well during the same sort of market cycle. So our caution would always be more and more advisors are getting access to software that allow them to sort of put managers together in a portfolio, back it out, and then say, well, this is my house view portfolio. The problem that we find is typically if that is your due diligence process and you're focusing on the quants of it, we call it the bandwagon portfolio. By the time you see the bandwagon, it's usually too late. It's putting together various managers that gives you great comfort to go and sell to the client because it looks fantastic, but 3 years down the line, that combination of managers look very, very different. And we find it every 3 to 4 years. We find that the specific names that are in the industry changes quite a little bit. So if you look at the asset allocation, there, whether you have a process that follows a sort of from conservative to aggressive, which is more sort of risk propensity based, there's obviously a asset allocation that will be optimal to give you the kind of exposure based on your risk propensity. I prefer need for risk, which is part of the risk profile, as the starting point, where because it's defined by the objective. Taking less risk for a client and letting him sleep better doesn't serve his purpose in the long term. But the bottom line is strategic asset allocation is that optimal long-term combination of assets. So if you consider, for example, why you don't do it regularly, the last time I think we really had to revisit the strategic asset allocation, the long-term view was early 2000s when the Reserve Bank mandate changed, and they were starting to, part of their mandate was to actually focus on inflation targeting. And we were used to having double-digit sort of inflation numbers for years, and your bond yields would sort of been impacted by that. You realize that if the Reserve Bank is going to have an inflation target that's going to be running between 3% and 6%, and they're going to be fairly successful in managing that, then your expectations on cash and bond yields in your long-term model, sort of modeling needs to be revisited. And those are the sort of instances when you go back and you actually rerun your strategic asset allocation. People talk about redoing their strategic asset allocation regularly. We don't think that there's any use to that. You should actually just adopt a tactical view that you can implement at a portfolio level based on market cycles. If you look at this, the sort of typical process that's followed in the industry is when you usually start off with a universe of assets or a universe of funds. In our world, there's this, and especially if you look at it from the offshore perspective, there's this massive universe of funds that you can invest into. So typically what a lot of the houses will do is that they would start off by having a screening process, a quantitative screening process where you can define the parameters of what you're looking for, and you can sift that whole universe down to a universe that you want to research. Called your house view, the funds that you have selected that you are going to use or invest into. If you look at it from a South African perspective, and this is just sort of recent numbers from ASISA, if you consider currently that there's over 2,000 Cisco funds currently registered. Okay, those includes also the offshore funds and currency denominated funds. It's actually quite daunting if you start off with that fund universe. If you consider on the JSE main board, there's only 163 shares that you can invest into. And if you look at the shares, you look at fixed interest instruments and ETFs, you're sitting at close on 800 listed securities in total. But from an advisor perspective, it's a massive universe. And typically is you reduce that to a universe of research funds, and then you ultimately decide on what are the funds that will make it into your house view. I think one of the things that we would always caution, and it's very difficult, and it's whether it's recent data or longer dated data, is be very careful of peer rankings. We know we love it, and we love our beauty parades, and we love to sell the beauty parades. But if you look at all the research in the global research and the local research, there's no proof of consistent outperformance. Nobody outperforms in all markets. This spaghetti sort of chart it's an older chart that I had on record, but it actually just shows you that the managers tend to do well in the long term, but all of them go through periods of underperformance. It's very interesting if you consider, it's a research that I recently read of funds it's in America, and they looked at funds that if you look at a period of 10 years, so not rolling 10 years, it was a defined 10-year period. And they looked at the top decile of funds, and they said, okay, so and it was up until end of 2015. Over that 10-year period, these we know are the funds that over the 10 years would have given you the best performance. Okay, so let's consider how many of these funds underperformed the average for a period of 3 years or longer. It was 94% of them. Then they went further and they said, how many of these funds would have underperformed their peer group or index for a 5-year period or longer? It was over 50% of them. And I think that's one of the big things that you want to try and manage as part of your due diligence process, is getting away from all of this peer group ranking and beauty parades, because ultimately you need to go through a process where you need to identify the fund managers that you believe are skillful and have a process that are robust and repeatable over time, And then you need to also have an understanding of what it is that you can expect from them through cycles. So what we have seen in the recent past as well is people would turn around and say, yeah, this fund manager is actually, there's something wrong. This is a manager problem. And then on closer inspection, you realize, listen, but this is not a manager problem. For this manager to underperform in this market cycle is part of his performance signature. It's a portfolio structure problem. You didn't understand what it is you can expect from this manager through the various cycles. And I think that's a part of what you want to try and ensure you get right when you make a selection of managers, is who are the quality managers that are skillful and not lucky and have consistent process and repeatable performance over time. But I
Marius,
see a question from Sean.
yeah.
Do you use a building block approach when constructing your portfolios, active as or active multi? How do you control your asset allocation portfolio drift? I will get to that. So our approach, and I'm not saying it's the right approach, but our approach is obviously we start off with strategic asset allocation. We have our asset classes. We prefer to use specialist managers. Just based because of the fact that we can do for us, if we don't use specialist managers, then we don't control the asset allocation, and if by virtue, as a result of that, we don't control the risk in the portfolio anymore. So from portfolio drift perspective, and it's Sean, thank you for the question, because I think what's very relevant is if you looked at, let's say 2003, and you had a 60-40, 60 equities, 40 bonds portfolio in the US at the beginning of 2003, and that's how you invested, and you didn't rebalance the portfolio going forward. By the time you hit the great financial crisis, the risk return characteristic of that portfolio, just by virtue of you allowing portfolio drift, would have changed dramatically. So you would have ended up with a 78% equity and a 22% bond exposure. So just when you went into the perfect storm, your portfolio didn't have the risk characteristics. So clearly, part of that process, and it's a mindful process, is it's always about risk and return. You look at your portfolio, you look at the drift in the portfolio. There's different ways also of correcting that. So what we don't do is to say unless it's, for example, a Reg 28 portfolio, every 30th of June you rebalance. That to us is a dynamic process, but it's also informed by what we see happening tactically in the market and what we believe are drivers of risk and return. So it might happen that we would actually allow a little bit of drift in the portfolio, but it's actually mindful. It's informed by understanding the drivers of risk and return, understanding where the market, or what we believe our understanding is of where the market is at that moment in time. It could also be shown that you could, for example, have
Marius, have we lost you? It looks like Marius has got a bit of a technology problem. He's phoning me. Just hang on a sec. I'll be with you. Yeah, Marius. Okay, let me give you that token. Okay, you're back in again. Okay, that's fine. Cheers. is back in the room. He's just getting himself sorted. I'm sure he'll be live again. Just bear with us.
Sean, just to sort of finish off on that point. So sometimes your equity exposure might be a little bit more than what you would prefer, but yeah, on a sort of a look-through basis, if you look at your underlying managers, you might find that the beta of your equity managers and that carve out of your portfolio is actually far less than the market. So then you don't really have to pull back from a risk perspective on your asset allocation, because just purely on a look-through basis, your beta looks very different to the market. And it's also tools that you use when you want to sort of reduce risk. You can reduce the risk in your equity component without actually reducing your equity exposure. And that's by understanding your manager selection, understanding sort of, do they look very different to the market? And from our perspective also, I'm not sure whether your reference to active multi-asset, we are very agnostic in terms of active management and passive. For us, it's all tools that are available for us to use. If you believe that you're in a market that's really convinced that you're in a bull market, then and it's going to carry on, then sort of having exposure to passives, cheap passives, could make a lot of sense, because you want to have the sort of the same risk of the market and a high beta. It's sort of akin to being on the sea and you have a boat and you just want to open your sails because you're happy where the wind's going to take you. But if you're concerned about the cycle of the market and you think you're sort of close towards the end of a bull run, then you want to look different to the market. Then you want to have your rowers, and you don't necessarily, then the risk that's being posed by having a passive in the portfolio is very, very different based on the market cycle, as opposed to having active deep value managers. But these are decisions that you make mindfully based on understanding where the market is within that cycle, but also an acute understanding of the managers and what you think you can expect of them. The next slide is just to sort of, just a very simple illustration of putting it together from and let's consider something like the fixed interest sort of, a fixed interest portfolio. Now, you can see at the top level here, it's comparing cash, long-dated bonds, inflation linkers, shorter-dated bonds, and to understand, firstly, here at an asset level, what is the relationship between these assets and their correlation? And this is just a portfolio for an example where you can see it's 55% cash, 15% LB, 25% inflation linkers, 15% short-dated. By putting together these just at an asset level, purely at an asset level, by combining them in a specific relationship, you can find that you actually reduce the amount of negative months. You actually, if we look at standard deviation as the statistical measure of risk, you can see that as opposed to across the asset classes, you reduce the risk significantly without diluting the return significantly. And again, depends on what is it you want to achieve at a portfolio level. So here you find asset level diversification, and here we look at managers. How do these, if you look at combining different managers. So if you look at the negative months there at the top, by just having a portfolio of one or two or three of these managers in combination, you reduce your negative months. But this is basically what you try and achieve at a portfolio construction perspective, is how do I get that standard deviation? And it's we'll focus on it later, downside deviation. How can we, by combining different managers, get a return where you don't dilute the return, but you actually reduce the risk significantly? In the next slide, you'll see this is where you look at the correlation of the asset managers to the asset class, and this is the correlation of the asset managers relative to each other. And here you can see as correlation relative to cash gives you, from a diversification perspective, you can see it gives you a different, it relates different to cash measured considering all some of the other managers. And typically what you try and find is, can I find managers that are skillful but also do things differently enough that if I combine them, I get a more robust portfolio where I can manage my downside risk um, more efficiently. And here you can see prescient from a correlation perspective to the other managers clearly has quite a value to offer, because they manage in the same space money very differently to the other managers. And the whole idea of diversification is to understand that the way that asset classes and managers correlate, the relationship between them, how that play out over time, has a massive bearing on how this portfolio will compound, and we'll get to that just now. And the whole idea with your correlation is, if there's perfect correlation, correlation is measured in either minus or positive. Perfect correlation means that if fund A or this asset or that asset moves up or down, it in perfect lockstep. If it's 1% up, this one will be 1%. Negative on the other side says it moves in different directions, and no correlation says there's actually no relationship that we can see that if the one goes up, the other one goes down. This is what you need to understand. This is what you need to go and measure, and what you need to go and model in a portfolio is having the humility to actually know that we can't divine the future. Having the humility to know that we don't know what's going to happen next. But if we have a good enough process and a good enough understanding, and we can put these managers together in the correct relationship, our clients should be fine in the fullness of time. And some of the tools that we use in this process is things to measure sort of diversification. Is sort of you probably have seen this many times, correlation heat maps. It could be between different managers. It could be different markets. It's all about understanding what is the relationship between different asset classes. Because I want to combine, I don't want to only hold. If you have a portfolio and all your assets and all your managers are doing well at the same time, then you are not diversified. And I think that's not the purpose of what we're trying to achieve. We actually want to make sure that when we are wrong, we know this portfolio will have shock absorbers in it. And that's why you need different managers, different investment styles that complement each other. And there's many different types of, you can do it across asset classes, within asset classes. There are different investment styles. Recently, we have seen momentum, the last couple of years, momentum styles have actually done far better than your value, deep value sort of managers. But it's based on the last 10 years. Well, we're close to having the longest bull run in history since March 2009. Will it carry on? I don't know. How long will it carry on? I don't know. It won't carry on. But if it turns, what does it mean for your portfolio? Have you diversified across geographies, time, and also market capitalization? In South Africa, we do less of this. It's more in the US, where you find that having exposure to small caps as opposed to medium and large caps makes a difference at a portfolio level, both from a return and a risk perspective. But ultimately, it's about understanding diversification. And many times we talk about it and we say, you want to be diversified, it's the only free lunch. And the question is, why is it the only free lunch? It's because we need to understand the difference between simple return and a compounded return. When you are busy with portfolio structuring and due diligence, it's important that you understand that what you want is to build portfolios that compound better over time. This is sort of also sort of an old slide, but what we did is we took long-term data on 5 different asset classes with the standard deviation. You add it all up, and if you divide it by 5, then your simple average return over that period was 15.4%, with a risk of 9.9. That was your standard deviation. But if you took these asset classes and you ran it in a portfolio, you rebalance it on an annual, equally weighted, rebalanced on an annual basis, then you would find that your compounded return looked very different to your simple return. In this example, it actually enhanced the return and it actually reduced the risk. It doesn't always enhance the return, but it always reduced the risk. And this is really just a slide you all would have seen in the past. It's saying is those sequence of returns, how you get to your return makes a difference. So if you look at simple, all of these 6 different return series, if you add them up and you divide it by 3, would have given you a mathematical, arithmetic, simple return of 5%. But that is not what the investor ever gets. What the investor gets is the compounded average return. And you can see where there are deep drawdowns, it affects actually how the portfolio compounds. So a big part of what you do when you are busy with portfolio structuring and putting asset classes and managers together is to try and understand what is the drawdown deviation of this portfolio. Because if I can keep my standard deviation low, my drawdowns low, I don't need to have a hell of a lot of the upside to get to a good performance. Okay, I think this is basically just summing up and saying is make sure that you understand what to expect of the different managers. And the reason for that is don't just put different managers together and different investment styles and believe that that equates to diversification. Sometimes by doing that, you're actually stacking risk upon risk. So you can have an equity manager of one house and a bond manager from another company. You put them together in a portfolio and you believe that you've diversified asset class and manager level. If that equity manager is overweight financials and sort of the consumer sort of stocks, then his portfolio has got a interest rate sensitive bet in it. Similarly, if your bond manager's got a long bias, long duration bias, then you know that although these are 2 different asset classes, 2 different managers, on a look-through basis, this portfolio actually has made a bet on interest rate sensitivity. Now the question is that an unintended risk or is it intentional? And that's what you want to try and do with the whole process of doing a due diligence, is to make sure that there's no unintended risk or unintended consequences in the portfolio. Portfolio rebalancing, I've already touched on this. It's something that we believe it needs to be done, but we don't believe in a mechanical process. Okay, so if we look at sort of at a very, very high level, our 4 pillars of manager research, one of the areas you need to focus on is the organization, institutional risk. Ultimately, you get rewarded or punished for the risk that you have taken. When you look at an organization, obviously it needs to be financially stable. You want to have the comfort that there's not only quality of management, but that there's management buy-in in terms of what they are doing within the investment business themselves. If you look at this, especially your smaller asset managers, your boutique managers, it's very important to look at break-even assets. So they start off a business, they have to build up a bit of a track record, they have some funds, but it's important when you do a due diligence to understand at what level is this business still economically viable. Because typically in some of these smaller managers, you will find a little bit of client concentration risk, people that's given them money. If they lose one mandate, then suddenly their assets can't finance their business anymore. Now, these are very important things to consider. Quality of the operations. Now, how do they execute? Regulatory compliance. Regulatory compliance is something that, well, typically what we believe is you do it independently and you actually verify with the FSCA itself. And to try and understand how do they operate, how do they run their business. If you look at it from a team perspective, obviously, this is where it's more qualitative. It's when you engage with them and you get an understanding, it's to understand, and it's not a good or a bad, it's sort of how many investment professionals is there in the team? Are they in the team? What is the depth and the breadth? And it's not saying a big team equals good and a small team, not at all. It's understanding with the people that are there, what are the quality of the decisions that they make? What is their years of experience? How long have they been together as a team? Is it a team-based or sort of environment or investment styles? So a company like Prudential is far more team-based. But if you look at John Bicard at Investec, it's more the investment style sort of approach. Why is it important? Because if it's an investment style sort of environment and that person leaves, then you don't want to be with that fund anymore. If you look at the staff turnover ratio, it's also important that you don't do it blindly. You need to understand who are the decision makers in the business. You need to understand. So, for example, we have some companies where there's one or two strong individuals within the investment team that makes most of the decisions. And part of their culture is having a lot of interns that come and go over time, and they don't retain many of them. So if there's high staff turnover in that environment, that would not be any problem for us. But if it is more sort of some of the senior people, then obviously it's a problem. And I think this last point of team incentivization, I think it's something that how is the team incentivized in terms of a bonus structure? Is it aligned with the clients? Because if it is short-term focus, then you find there's a mismatch between how the team is rewarded and how the clients get rewarded. And if that mismatch is there, our experience has been that there's usually ultimately you're going to run into some problems. Their philosophy and process, again, that is about is how do they think? What is their discipline? Is this a repeatable process that they can evidence? If you can't understand what they do and how they do it, walk away. It's never, you can't get duped by sort of short-term performances. You need to have an understanding of how do they manage money. And also as a team versus individual approach, again, is we don't have a preference. It's just having a proper understanding within that fund, within that team. How do they make decisions? Who are ultimately held accountable? What is the quality of the research? Is it driven from in-house, or are they buying it from the sell side? There are some people who sort of buy from the sell side. We question sort of, so what is it? Everybody's got access to that. How does that give you any opportunity to differentiate yourself in terms of your decision making relative to the industry? And quality implementation. Having a great investment team, having great people, but poor implementation leads to disaster. And again, the last point is when we look at the quants, it's actually where we look at all of the different risk ratios. But to us, quants is always looking at historic data. It's the problem with quants with a lot of South African funds is also that a lot of the managers don't have long enough track records that you can actually make a meaningful decision based on the quants that you currently have on record for them. So in essence, I think it is managing the whole process of DD and research and selection. We don't believe what it shouldn't be is don't focus on past performance. Unfortunately, that's where we are currently as an industry, but it's been proven to be destructive for clients in the long term. So don't rely on standardized documentation processes. The fact that you've sent out a questionnaire and you got all the answers, if you haven't verified and interrogated the information that was provided, it means nothing. What we believe it is to understand what is the drivers of performance. You need managers that you believe are capable of providing long-term future results. You want to separate the lucky from the skilled. I think ultimately it must be investigative discovery process. Unless you know what you're looking for, you start, why am I doing this? What am I trying to achieve? How would this managers add to what I'm trying to achieve? Then you need to sort of stay away. Some of the outputs, I'm just going to sort of the last couple of slides I want to go through quite fast. I'm see from a time perspective. These are typically some of the outputs you would have in the different asset classes. You would have scoring system. You would have seen the company from a qualitative perspective. You would have rated them. You would have looked at the quants. That would have helped you to build a sort of a picture of that investment universe. A lot of people look at using sort of your risk return scatter plots based on rolling periods. That also gives you some insights. And then you find looking at it from a quartal perspective, looking at it from a drawdown perspective, and all the various risk stats. There's a host of tools that's available for you to look at the past performance and to back that out. I think part of what we try and promote is to say these are tools that we use. Don't rely on this, and don't go and backfit an investment story that gives you comfort and embarrass you a year or two out, and yeah, your clients as well. I think the one of the sort of lastly, a lot of the due diligence and the discussions focus usually on investment, the whole process and the performance. Ultimately, and I think this is one of the most neglected areas in South Africa from a DD perspective, is understanding the difference between the investment DD and the operational due diligence. Operational due diligence, these are the risks that you try and understand, because if you take them, your intention is to benefit from it. These are operational due diligence. These are the risks that you have no upside for. You can never benefit by taking them. You want to understand them because based on your understanding, that will help you to avoid some of the pitfalls. If the trading execution is poor, there's no upside for you. If there's problems with the way they do their pricing, for example, and one of the areas where you find that it can be very dangerous is in the fixed interest space, interestingly, where depending on how they account for the performance within their portfolio, we have found in the past that they would use an accrual accounting methodology on a fixed interest instrument that creates the impression it only makes annual payments, but they accrue on a monthly basis as though the payment has been received. And then when it doesn't get received, then suddenly what you thought the risk profile of that fixed interest fund was and what it actually manifests to be is very, very different. But these are the kind of things you would pick up actually on operational due diligence if it's done properly. And I'm going to end off with just sort of two of the train wrecks that I've seen in the past. And years ago was LeaderGuard. And I think from an advisor perspective, this is why it's for me very important. If you look at what happened with LeaderGuard, they went and they actually convinced a lot of advisors that what they have is a low risk, high return solution where they were trading currencies, hedging out all the risk. And a lot of advisors were marketing LeaderGuard in the sort of early mid 2000s. Anybody that thinks that trading currencies can in any world be low risk, you need to question. But what is the result of it? So LeaderGuard, like all of these things, it did blow up. Who carried the can? It was actually the advisors. They sort of the FSB won their case, the on-bid, they had to repay clients, they paid penalties. If you look at the people who ran LeaderGuard, it was a Mauritian-based registered company, South Africans, who had the masterminds who were sort of persecutable. They were criminally charged in Mauritius, and they paid about, I think their fines in total was 480,000 rand. No jail time. They're back in South Africa, living large, and the advisors ended up by not understanding what they were investing into. And that promise, they were selling the promise instead of a process that would have sort of helped them to not step into this. And I think the last one very recently, and why I bring this up is it's just the irony of it. If you look at ShareMax was also something that if you just had half of a due diligence process, you would have picked up, but it's not FSB approved. You would have to, if you read the prospectus of the various companies, you would have realized that there's no separation between sort of the management and the money. There was no separation between either execution level, but people still, based on the promise of performance, sold these things. Now, the irony is, again, this company was placed into business rescue, and the company that is now busy with the process of managing the business rescue is called Nova. Now, for me, the irony is if you look at the company that's doing the business rescue, of the 4 directors that runs the Nova, 2 of them are ShareMax directors, and they seem to be creaming it again. So the message, final message that I want to sort of impart is our industry and our processes should not be focusing on beauty parade, best performance, the greatest. It should be focused on process. It should be not the greatest. It should be on what is good, what is a good process, and how can I evidence that my process actually I can match back to the objective, and I can match my objective back to my advice relationship with the client. That's it from me. Thanks a lot.
Excuse me, Marius, thank you so much for your insights. The manner in which you impart your knowledge is greatly appreciated. I certainly hope that those present today have drawn significant benefit. I think the message that comes through loud and clear here is that apart from determining your risk profile and the 3 elements of the risk profile being tolerance, needs and objectives, capacity, matching the portfolio, building the portfolio, ensuring that the portfolio is always matched to the risk profile is of paramount importance. So I think that message has been delivered loud and clear. So next week we will start putting it all together and chatting about how best you implement and deal with these challenges and implement solutions to make sure that you navigate through the really topsy-turvy and stormy waters of the regulatory environment and the changing financial services industry. So what we're going to do now is close off the presentation and then start the assessment. So we'll have 15 minutes and I'm going to start the assessment now.